How do you know what to invest in? This is a question I get all the time because people are genuinely confused as to what to invest in. There are a million different things you could invest in. You can invest in stocks, commodities, cryptos, bonds, mutual funds, you have real estate. Even entrepreneurship is a form of investing. So how do you know what to invest in? Well, I'm going to share with you an easy way that you can determine what it is that you need to invest in. And this is based on 4 pillars. That's personally what I call them, the 4 pillars that determine what you invest in. So let me tell you what these 4 pillars are before I go into more detail. So the 4 pillars that determine what you invest in are your goals, your risk tolerance, your time horizon, and your financial situation. So let's go over those again. So your goals, your risk tolerance, your time horizon, and your financial situation. Those are the 4 pillars that can help you to determine what it is that you invest in. So now let's go through these 4 pillars one by one to help you make more sense of it. So first, your goals. Your goals is simply what you want to accomplish from your investing. So the whole reason you're going to be investing in it is because you want to accomplish something, right? Whether it's you want to buy a house or you want to buy a car, maybe you want to pursue higher education, maybe you just want to pile up a bunch of money for retirement or to go on a vacation or whatever, right? Your goal is ultimately what you set out to accomplish through your investing, and what you want to accomplish will largely determine what it is that you do to get to that goal, right? Because for example, if you know that your goal is going to be a short-term goal, let's say you need the returns in a month or a week or whatever, you're not going to invest in a long-term asset, as that would not help you to accomplish that goal, right? So you have to choose a type of investment, an investment vehicle that can help you to accomplish your goal. The next pillar is your risk tolerance. How much risk are you willing to take? Some investments are riskier than others. As a matter of fact, sometimes you just investing more money into a particular asset or into a particular investment will inherently create more risk, because now you have more money to lose. But some investments naturally just carry more risk. You might hear a word going around in the investing community: volatility, right? And volatility simply means that the price of the asset or the investment fluctuates, or it changes a lot in the relative short term. So for example, crypto is a highly volatile asset, and for that reason it carries a lot more risk than, say, your mutual funds or your unit trusts that are a lot more stable in price. So how much risk you're willing to take, and whether you're a conservative investor, you don't like to take a lot of risk, or you're on the riskier side, you're a riskier investor, you invest more aggressively, meaning you like to take a lot of risk, that will determine the type of investment you invest in. Because if you're conservative, you're probably not going to invest in crypto. And if you're more of an aggressive investor, you're probably not going to go the mutual fund or the unit trust route. The third pillar is your time horizon. How long are you willing to invest for? Your goal is going to be time bound by nature, because depending on what your goal is, it might take a shorter or a longer amount of time to accomplish that. So maybe something like purchasing a car can be done faster than purchasing a house. And then things like retirement, you know that those would be super long-term goals, because chances are if you're younger, let's say you're in your 20s or your 30s, it's going to take you a lot longer to get to retirement than it would take you to, say, buy a car or to buy a house, for example, right? So depending on your time horizon and how long you are willing to invest for, that will also shape and determine what particular investment you put your money into. And the fourth and final pillar is your financial situation. Now, for example, sometimes depending on your financial situation, it might not even be the right thing to invest. Let's say that you're somebody with a lot of bad debt. Let's say you have a lot of credit card debt, and you know credit card debt can be 50-60% plus, right? That you'd be charging interest per year. Now, if you're somebody that's carrying a lot of bad debt, especially high interest debt, it might serve you better to pay down that debt and get rid of that interest expense than to invest, because chances are you clearing off that debt and getting rid of that 50-60% interest might serve you better than, say, investing in a unit trust or mutual fund or whatever, where you might get a 5 to 10% return, just as an example, right? So in scenarios like that, it would make more sense to clear off the debt rather than invest, as well as different things with your financial situation can also determine largely what you invest in. So things like your income and your expenses, for example, as well as just how much money you're able to budget or allocate towards saving and investing. Because for example, somebody that makes $1 million a month that has no form of bad debt or no major expenses that can potentially save, let's say, $500,000 from their salary, they will have options to invest in a lot more assets, even multiple assets at the same time, than say somebody that after all the budgeting for their various expenses and bills are only left with say 10,000 Jamaican dollars, where that might only allow you to maybe invest in maybe stocks or unit trusts or mutual funds, right? So depending on how much money you have available to you, how much cash you have available, that will also determine what you invest in, right? Because the person that has more money can invest in maybe assets that require a larger capital outflow or a larger amount of money to invest in it, right? So that will also determine what you invest in. Now, with the 4 pillars out of the way, an easy way you can go about doing this is get a piece of paper, maybe type it on your phone, whatever works better for you or whatever you prefer, and set down these headings. Set down goal, set down risk tolerance, set down time horizon, set down financial situation. And then you're going to start. I would recommend using one goal instead of putting down multiple. So let's say, for example, your goal is to buy a car. On the goal, you're going to put buy a car. That's what your goal is. Risk tolerance. Put down what you think your risk tolerance is, whether it's conservative or moderate or aggressive, right? Doesn't have to be accurate, but you want to kind of get an outline of what it is that you're doing. So let's say you put down that your risk tolerance is moderate, right? So you're willing to take a bit of risk, but not too much. So you know that your goal is to buy a car, know that your risk tolerance is moderate. Now let's say for time horizon, you think that you're going to be able to do this in maybe 2 to 4 years, or let's say 2 to 3 years to keep it simple, right? You put down your time horizon is 2 to 3 years, and then your financial situation now, try to see if you can put an overview or a summary of what your income is like, what your expenses are like, and how much money is left over after that to save and invest. And then from there, you can start to kind of structure a plan. So for example, I want to buy a car. I'm a moderate risk taker. I have 2 to 3 years to do this, and let's say when I do the math, from my income, I'm left with $10,000 a month, right? You know that, for example, if over these 2 to 3 years, you were supposed to save that $10,000 every month, in the first year, it'd be $120,000, second year, it'd be $120,000, third year, it'd be $120,000, for a total of $360,000. Now, let's say that you want to buy a car for $500,000, just as an example, using simple numbers. You know that the gap that you need now is $140,000, so you need to make a return of $140,000 on the money that you are investing. Now, as a moderate investor, you might say, all right, I'm willing to take some risk, but not like a whole heap of risk. So maybe I'll invest in stocks, but maybe I'll look at stocks that are more, say, blue chip stocks or dividend stocks that carry a bit less risk than, let's say, your newer companies or your newer stocks that have just come on the market with not as proven a track record, or are not providing income in the form of a dividend. And you can see how these things are going to kind of come together now to help you to make a more informed decision, because now it becomes a bit easier when you have these pillars set down. You kind of outline what it is that you have to do, because now you have a rough outline of a plan, and then you can start to make it more and more detailed as you go along. But this is just how I go about my process. This is actually just the first step in my opinion, because of course there's much more that goes into it. But I just wanted to make a video to help you to get an understanding and appreciate the process, and kind of help you to determine how you go about deciding what to invest in. So if this video was helpful, definitely leave a like, favorite the video, share it out to anybody that is interested. Comment below your thoughts, your opinions on the video and the content. If you have any questions as well, comment them below. And remember, if you're not following us or subscribe to us, definitely follow us or subscribe to us, whichever platform you're on, whether it's TikTok or Instagram or YouTube, wherever, right? Definitely follow, subscribe, share out the content. It really helps a lot, and I appreciate it as always. Take care, guys.